from Ticker Tape Investments to talk about last minute tax tips. We've got a lot to cover tonight, so I'm going to move pretty quickly. The idea here is things that you can still do before April 15th. And we're going to talk about one thing that justifies asking for an extension, perhaps depending upon your specific situation. But for the most part, we're talking about last minute things you can still do today that will reduce your tax bill this April 15th. That is your 2025 taxes. I know you guys have seen these presentations. We typically do them twice a year, right before April 15th, and then in the month of December for the list of things you can do during the calendar year that can help save you on your taxes. And of course, we have all sorts of content of various tax strategies and tips, everything from creating trusts to charitable foundations, etc. But today we're going to focus just on the last minute things that you can do before the end of the year. I'm going to go ahead and turn off my camera so you guys can see the entire slide, and then we'll go forward. So first of all, if you are a high income earner, whether it's because of your activities, your professional life, or your investments, the biggest tax mistake isn't what you did last year, it's what you failed to do before April 15th. That's kind of the topic of today's presentation. So first of all, there are 4 things that we're going to talk about today. Number one, we're going to talk about the moves that most people don't realize are still available. In other words, I know a couple times in my life, I've missed December 31 as an imagined deadline. And then, oh my gosh, turns out there was more stuff I could have done. So we're going to talk about that. Immediate reductions, whether it's retirement accounts, HSAs, and expense captures, advanced moves, little known strategies that high income investors use. And then we'll talk about some things as we go along that you should plan for your 2026 strategy. In other words, past the April 15th deadline. So first of all, these are some of the key things that are still open right now that many people miss. First of all, you got to go through all your retirement accounts, right? Make sure you've maximized everything. If you're over the age of 55, make sure that you've taken advantage of all of the catch-up contributions that are available, etc. And I encourage those of you who can justify it to open new accounts, right? If you don't have an IRA, if you don't have a Roth IRA, if you don't have a SEP IRA, if you don't have a 401k plan for your individual business, make sure you get with your CPA literally tomorrow and find opportunities to take advantage of those deductions, because literally it will help you in the future in your retirement planning, but more importantly, it's an immediate reduction in how much cash you have to give to the federal government. HSAs, we're going to talk about that a lot. I think that's number one of the most valuable tax strategies you can employ, and probably most misunderstood. People don't really understand the power of a health savings account. So we'll talk about that. The other thing that we find a lot, and talking to CPAs we see a lot, is go back and go through the prior year, right? The number one way to do this is take your 2024 and your 2023 and your 2022 tax returns and give them to a different CPA, right? Hey man, do me a favor, look through this and see what you can find that we might be able to change that can get me a tax refund from a prior year. But also, you got to go back and look at 25, right? I know you probably had an idea of what you were doing to maximize expenses and minimize income, but there's always a second or a third look. You can find a few $1,000s here and a few $1,000s there, and next thing you know, you got a 5-figure savings. So make sure you go back and look at them. And these are not theoretical things. These are all things you can do between now and April 15th, a little over a month from now, and save money on your tax bill. People, we see them every day leaving $20,000, $30,000, $50,000 on the table every year. You know, these retirement plans are the biggest, fastest way to do it, and it helps you improve your savings. One of the things I didn't know about until recently is a solo 401k. And for that, you can set that up for, create an LLC if you don't have one, set it up, and then the deadline is passed for you to make your personal contribution, but you can still create it where the employer, quote, your LLC, makes a contribution for you, and that can still be funded and create tax-free savings for you going forward. The SEP IRA, if you have any kind of self-employment business, even an investment business, we encourage you to set up a SEP IRA, and we'll talk about how you can use an extension to help you with that as well. And then, for the love of Pete, you should be maximizing all your IRAs, Roth and traditional, catch-up contributions, etc., if you're able, and make sure that all of those are in self-directed IRAs so that you can take advantage of a wider set of investment opportunities. This is a little known thing that I learned recently. Like, I always knew, hey, you can do a SEP IRA, hey, you can fund it up until April 15th. What I did not know is that if you file for an extension on your tax return from April 15th to October 15th, the funding deadline for the SEP IRA extends to October. So let's say you're a doctor, lawyer, accountant, whatever, you're earning money every month. Hey man, you know what? I don't have 70 grand to put in my SEP IRA for 2025. I didn't do it before. I didn't get it done in time. And so, hey, I'd like to do it now, but I don't have 70 grand sitting in my checking account. We'll do it, 10 grand a month, right? For the next 7 months. Or even if you only did half of that, getting that extension on your tax filing deadline extends the funding date. Now, big important note here, 2 things. Number one, you still got to do your estimated tax payment. Of course, you can estimate it a little lower if you're going to fund the SEP IRA, but make sure you don't get yourself in trouble that way. The other thing is the SEP plan, the IRA, has to be set up, I'm told, before April 15th. In other words, you don't have to fund it, but you have to set up the account. So make sure you get that done by April 15th. And of course, like everything else, I'm not a CPA or a tax lawyer. Make sure you double check this with your CPA. Number one, there could always be little nuances that aren't included in this quick presentation that affect you. Number two, these things are not necessarily available for everybody, right? You may have a specific situation where you don't qualify for a SEP IRA, and so make sure you double check all that with your CPA. This is one of my favorite ones, and it's in giant bold print. I made the font as big as we could because I do think it's the most underrated tax shelter in America. So there are different kinds of accounts like this. There's probably the one that your employer offers you where you have to spend the money by the end of the year. That is not an HSA. An HSA has several different benefits. Number one is, of course, it's tax deductible, and you can still fund it before April 15th for 2025. And let's say you fund $8,300 for the family, what are you going to save? Almost $3 grand in tax just from funding this account for yourself. If you're older than 55, you can even do the catch up. So double check those numbers, but it's certainly in the ballpark of $9,300 if you're over 55. Take that money, put it in an account. Schwab will do it for you, Fidelity, any of the major banks, and then invest it. Don't use it for healthcare, right? So let's say that you do this, you put $8,300 in there, and then something, you get a bad blood test or something. They say, hey, go get a MRI, and you got to write a check for $300, $500, let's say, for your MRI. Most people would say, oh, well, I should take the money out of my HSA. Wrong, Tex. Fund it yourself. Take the receipt for the payment and put it in a file. That money is refundable to you forever from this account, so long as you have that receipt. So in other words, you put that $8,300 in, don't take out $500, let it grow and grow and grow, and 3, 4, 5, 6 years from now, when it's $47,000, then you take the $500 and reimburse yourself out of that account. The cool thing about this is that account grows tax-free. You can, any healthcare expense you have in the future, you can use it tax-free to fund that, even after the growth in, let's say you buy Tesla, their Optimus robots go crazy, it goes up in value. Now you sell it in order to pay some medical bills. You pay zero tax, not only on the withdrawal but also the gain from the stock that you bought. Huge advantage, right? And then, by the way, let's say that you get lucky, you don't have any health expenses in retirement, you can still withdraw the money for non-healthcare related items, and it just treated like a traditional IRA withdrawal. So then you would pay tax on it. So in other words, it's not like you can't get the money if you don't have healthcare expenses, but chances are you're going to have opportunities to use that money tax-free to pay for health benefits. And again, I'm told you don't have to spend the money at the end of this year. So it's not like you're wasting it as prior health savings accounts, or not health savings, what are they called? Medical savings accounts have created problems in the past for people. That is not this deal. So go to your CPA tomorrow, say, hey, is Tom right? Does this make sense for me to create an HSA? They may say, well, no, you've already got one from your employer deal, or, oh yeah, we've been doing this for years and you just didn't pay attention to it or whatnot. But if you're not doing it, everybody should be doing this because it's an immediate tax deduction and you get the tax-free growth of that money. I mentioned this one a little bit earlier, expense review. Make sure you're not leaving money behind. Most of the time, a fresh set of eyes can go through your 2025 expenses and find stuff that either you didn't capture as a business expense, you could recharacterize and you haven't. Maybe you classified something as income where it shouldn't have been, or you classified it as passive income where it shouldn't have been. But make sure you double check depreciation schedules, Section 179 elections, cost segregation opportunities on real estate deals you've done, bonus depreciation. And remember, we're in a weird situation today because of can't even say it with a straight face, the one big beautiful bill, which created a lot of new tax benefits for business owners and individuals. And so what you did last year may no longer be valid. Make sure you go back, double check everything, find what you can reclassify. Probably the biggest one, if it applies to you, is cost segregation changes from real estate deals, where you can take costs and reclassify them so that you can deduct them in your 2025 tax return rather than carrying them and depreciating them over multiple years. So all these sort of things are worth a second look. I'm not going to spend a lot of time on this one because we talk about it in some of the other ticker tape presentations, but if you don't know what a qualified business income deduction is, make sure you figure it out ASAP. Anybody who's a high income earner, whether they're an investor, business owner, or just a straight up doctor earning a salary, you need to make sure that you're creating a business, that business is generating the income, and you can automatically deduct up to 20% of that qualified income. And so there's ways you can modify and adjust your income levels by allocating income to different businesses, different segments of your life, and change W-2 wage allocations. Some of those things you may learn today, hey, I didn't do it last year, I need to do it for next year. But in the process of evaluating it, you ought to be able to find ways to get to maximize that deduction for your 2025 tax return. This is another big one, right? Again, I mentioned this earlier, take your last 3 years tax returns, give them to a new CPA, a different CPA, and say, hey, I want to double check and make sure I didn't miss anything in prior years. Make sure they're fully up to speed on your business situation, what could have been classified as income or expenses, et cetera, self-employment optimization, all those sort of things. One CPA told me we regularly find 5-figure missed opportunities when we review prior year returns for new clients. That's a big thing, right? I'm not saying change CPAs. I'm just saying, hey man, let me pay you to look at these 3, see what you come up with. The CPA typically will do it for free because they want to get your business. So maybe you pay them to file your 3 amended returns, but you stick with your old CPA going forward, but that's up to you. The point is, fresh set of eyes, go back and see what you might have missed. This one is a kind of a whole web of conversations. You may have heard me talk about this before. The big message here is when you're thinking about your taxes, make sure you think about timing. This is a big thing. And I learned this early in my professional career, not because I was trying to maximize deductions, but because I think the first thing that happened was my CPA and I made a mistake and recorded, I think it was an income item in the prior year when it should have been posted in the next year. That is, delayed my taxes on it. And the conversation was, well, it's just a timing difference, so you don't have to amend your return, was his comment. That got me thinking about timing. I've also dealt with issues where there are restrictions on what you can do for an employee in their bonus structure that the IRS doesn't let you manipulate when income comes in, that sort of thing. So it's come up there. But the point is this: I pay attention to, in the year that I'm in, like right now it's 2026. So during 2026, I start paying attention to, is this a high income or a low income year for me? Number one. Number two, is this a high expense, that is deduction year, or a low expense deduction year for me? And then depending upon where this year falls, I might try to bring in extra income this year, or I might try to delay extra income until January 1 of 27, right? So that's what I'm going to be doing going forward. Going back, I want to look at what happened in 2025, what happened in the last week of December and the first week of January that might benefit me if it was in the other annual year, right? Let's say that I wrote a check, I wasn't thinking, and I wrote a check for 50 grand for some legitimate business expense on January 5th. Say, man, I really wish I could deduct that on my 25 taxes instead of having to wait till April of 27 to get the money back, right? So the way you do that is, well, first of all, you may not be able to. Obviously, whatever you do has to be legitimate, but there are some things you can do. First of all, when did that expense accrue versus when it was paid? If I do my tax return on a cash basis, then the year in which I pay the expense is all that matters. If I'm doing my taxes on an accrual basis, however, and that expense accrued in December, but I paid it in January, then it's eligible, potentially, depending upon what else is going on my tax return, eligible to be a deduction from the prior year. Now, this works in reverse also, right? So let's say that you paid the $50,000 deduction in 2025, just last week of December, but you paid it early and it didn't really accrue until January, and you might be in a situation where you need that deduction more in 2026 than you did in 2025. So the point of this item is pay attention to timing of expenses and income, but also pay attention to your accounting method. And you have to talk to your CPA about this. Without knowing what's going on with your returns, it's hard for me to give you a full analysis of this. But go talk to your CPA and say, hey, number one, how are we doing it? Are we filing on a cash basis? And if so, is there any reason why I might benefit if we change to an accrual basis or vice versa? And just make sure you're aware of it. I've used the example before. We have an oil and gas lease every year that expires in November. It's, I guess it's a 3-year lease, or this year it's a 2-year lease, so it expires this November. So when it comes time to renew it, they're going to say, okay, we want to renew, and we give you a check for 200 grand. Well, it matters, obviously, whether that check comes in before December 31 or after January 1, right? So that's part of my planning of the negotiation of the lease, the method of payment, how it gets paid to the various entities that are involved, et cetera. And so thinking about those things, you could end up saving some significant money on your tax return. This one is not as good as it used to be, but it's still out there, right? So the One Big Beautiful Bill did increase the SALT limitation, state and local taxes limitation that Trump put in during his first term. Has now been increased. So it does matter for that. As I understand it, I live in Texas where most of I don't have any income tax, local or state, but I do have very high property taxes. So for years, what would happen is I would get my, let's just say 2025 tax bill in December, and I would pay it in January. And then let's just say January 2026. And then because I was doing my tax returns on a cash basis, I would deduct it on my 2026 tax return. In reality, what I should have been doing is deducting it on the 2025 tax return. So the note here is, if you still haven't paid your state or even local income taxes for these dates are old, but 2025, pay it before April 15th and then deduct it on last year's taxes. Again, talk to your CPA about how to do this. Again, as this last row is saying, it's saying if you're paying your 2026 property taxes today, paying them early, like a year early, that's not deductible last year. It has to be taxes for last year or the year before, but definitely something you can take advantage of. This slide remains in this presentation because I still have people who tell me they haven't done this even after COVID, right? Of course, I've been doing it since way before COVID. The first house I ever bought was, it was classified as a 2-bedroom house because the 3rd bedroom or room did not have a closet. And it was designed, when they designed the house, they designed it to be an office. And so the realtor told me that. And of course, back then, no one had a home office, but I was like, wow, I'm going to have a home office. So then immediately I started deducting a big chunk of my house. That goes way back. What year would that have been? 1997. Holy smokes. But make sure you're deducting some portion of your rent, your mortgage, your utilities, your insurance, any other home-based expenses if you're using a portion of your home for business. You know, a simplified method is $5 per square foot up to 300 square foot as a maximum deduction of $1,500. That is, you know, if you're at a 3rd tax rate, that's $500 right back in your pocket, and it's a very simple sort of calculation. Or you can deduct the actual percentage of home expenses equal to the percentage of the square footage used for business, likely to be a higher number, but would require some sort of calculation / legitimate support for that amount. Again, go to your CPA, say, hey man, am I doing a home office deduction? If not, please add it immediately. That's all we have for tonight. Try to keep it under 30 minutes, but reach out to us if you have thoughts, questions. If you need links to prior presentations that we've done on tax tips, we do lots of them. If you live in Houston, we are doing a dinner on April 1st. Make sure you come join us. And if you haven't got an invite, reach out to Rita. And if you live in Minneapolis, we're doing our first Minneapolis luncheon on May the 1st. And then we don't have any other events planned on the schedule now, but we will be back on Thursday afternoons doing these educational presentations starting next week. Thanks for everybody chipping in and talking to us. And if you're looking for a place to deploy some capital, we have multiple open deals right now that we're pretty excited about, and we'll keep on trucking. So reach out to Rita. Best way to get her is by text, 832-459-7335. Everybody have a good evening.